Welcome to the Colby 401k timer video where we're going to show you how you can manage your 401k plan better than most advisors in this country with only 3 trades per year. That's right, 3 trades per year. Warren Buffett tells investors he tells investors to put their 401k money in an S&P 500 index tracking fund and forget about it. We admire Warren Buffett, but we're not sure that's the best advice for everyone based on your age and risk tolerance, and that's why we have the 401k timer. If you took Mr. Buffett's advice and invested in a S&P 500 index tracking fund, here's one on this chart, ticker symbol SPY. It was introduced in 1993. If you bought SPY the day it came out in 1993, at the end of last quarter, you would have a gain of 1,530%, which is astounding. You did have to endure some high volatility and high drawdowns in a couple of bear markets, but if you were able to just hold on, you would have 1,530%. However, if you use the 401k timer to trade SPY and the stable value fund in your 401k plan, you would have an even more astounding gain of 2,298%, which is 50% more money over that time frame. 50% more money. Would you like to have 50% more money with lower drawdowns and less volatility? I think everybody would. This information is for you if you have no idea what to do with your 401k, you don't want to do a lot of work, and you want to stay in the market during the good times and get out during times of trouble. Who wouldn't want that? Big market trend changes are opportunities. They're opportunities. For example, the S&P 500 lost over 50% of its value in 2008. 56% actually. In just over a 1-year period of time. Mr. Buffett wants you to sit through that and do nothing because what does he think? The market will come back. It always has come back, but when will it come back? Just because the market rebounded in 5 or 6 years, the last 2 bear markets, doesn't guarantee it will do that again. It could take 10 years. It could take 20 years. If you don't have 10 or 20 years, continue listening. Here's an example of what the 401k timer did in the 2008-2009 bear market. Near the top here, the 401k timer went to cash in January 2008, early in the bear market cycle. Then the market went down 49% from that point. The market rebounded and the 401k timer bought back in July of 2009 when most people were still shell-shocked over what had happened. So the market timer went out and came back in at a point 25% lower than when it went out. So we sold high and we bought low, which is the basis of investing. That's what leads to this outperformance. This is not some crazy trading program that's hard to follow. The 401k timer trades on average 3 times per year. Sometimes it's 0, sometimes it's 6 or 7, but on average 3. We'll send you an email update every weekend with a 401k timer update that looks like the image on the right. We'll tell you how much money to put in the S&P 500 and how much money to put in the stable value fund. There's a table that lists the different investor risk tolerances. If you don't know your risk tolerance, there's a link in each email where you can go take a quiz. You get the email, you reallocate your 401k plan over the weekend when you have plenty of time. Then you wait for next week's email and enjoy your week. You've done everything you can to protect yourself in a bear market or to reap the rewards of a bull market. For a limited time, the 401k timer is free. That's right, it's free. Why? We believe everyone in this country should have this information. This is unbiased information based on mathematics, not somebody screaming at you on TV or trying to sell newspapers. This is a math equation that we're sharing with you at this time. You do have to opt into the 401k timer now, so go to colbyassetmanagement.com/401k timer. That's colbyassetmanagement.com/401k timer. If you ever have any questions, write us at info@colbyassetmanagement.com. Thank you for listening and stay safe.